Welcome to TradeTheMBI.com. This is John. This report is for the 21st. Well, Powell did what he was supposed to do. He came in soft and said that the Fed wasn't going to do anything at this particular stage, but that, they're just going to hold off and be accommodating at this particular stage. That was all the market needed to hear, which was what they were expecting. They still believe that rate cuts are happening this year. And well, according to some of the estimates, that's what a 75% probability is the estimate. Of course, if that doesn't happen in June, who knows where things will go at that particular stage. How it's justifiable, nobody knows, given what we're seeing from inflation. It's not stopping. The ES makes new highs. The NASDAQ just gets up to their highs. And you can see the MBI Magenta led through this whole situation right at the support levels. Nothing of a surprise with the rising gold and continuing from a shakeout positive standpoint. That's all we look for, is that rising histogram to continue to move that way. Kind of an even split here when you look at the NASDAQ of cyan starting to creep up along with DOC red and green, as well as short-term buyers. So that's still positive. An overtake would have been even stronger, but we expected new highs to be made anyway, so that wasn't really too much of a shock. Treasury's not fading as much as you might expect given the softness of that, but at least in a more reasonable range, and that offers some comfort, but not really when you think about the rate of inflation acceleration that's going to take place, given where oil has already started to go. It's not going to keep up, and so that's going to force everyone still into stocks at this particular stage, or alternatively into crypto. The euro got very excited about that because it just means that they have a chance of not falling too far behind. It literally is the best way to describe it. They're already behind as far as rates go. They can't change rates or even loosen, but relative to the dollar, they think that there's a chance that later on this year they'll be able to catch up. And that did exactly what we expected. Gold exploded, faded all the way back. They tried to keep that moderate, but is already starting back above into new highs. And no shock with that. And the same turnaround from crypto. So we get that partial fill of a lot of positive extremes, and boom, pop right back up again. And still looks pretty decent. Rising steel got above that negative 13.5, and that's what you look for from a support standpoint. And continuing to plug away, and that's very healthy from an extreme with those nice green histograms there. So that should continue to plug away. ETH came all the way down to its 50% levels, so it filled in all the positive extremes from this initial ride up. The early one, going all the way back to here, you'd have to have some major market event to see that level retraced, but needless to say, it was just more of the same. And this is what happens in an election year. You got to keep things soft and positive. And this is beautiful from a 50K standpoint. Cyan under red, always a buy in that situation. And then it was just a matter of every dip of steel, taking an opportunity to load into that one with the cyan underneath, and then every turnaround pop of the steel higher, and it just continues to rise. And so that was a pretty good move, all on positive extremes, going all the way back to the initial breakout. Those early ones got filled, and then we started with a new set right up here. And those become the next new levels. It's interesting because when we look at that daily, if I pop it back up again here, you can see there's going to be some significant levels to fill back into later on when there is a sell signal. So that's going to be worthy noting in the future. Not yet. Depends on if there's some kind of catalyst that will drive that. And at this particular point, with general market conditions from an economy standpoint being relatively neutral, you're just continuing to plug along. And that's literally all the market's looking for at this particular stage. And we can see we were relatively neutral until Fed came in there, and when they saw that they were going to maintain a more accommodating pace and kind of push the can down the road and basically say, oh, yeah, we'll cut now and maybe we have to increase later on, but maybe we won't do anything at all. And that's all the market needed to see it. And you can see it propelled itself all the way to the highs there and continuing it here in post market. Um, so still very strong and no end in sight. And we'll just continue to plug away like that. And at a certain point, though, this relative expense of the debt is going to have an impact. But as long as they're continuing to print endless amounts of money, you're not really draining from the capital reserves that exist. In previous years, when we weren't just creating money out of nothing at such a rapid pace. You would have had to go to the capital markets to pay for this debt, and that would take away from the ability to loan within the economy, and that's not the case any longer as they're doing this. And so that just gives them an unlimited ability to do it, but it's a rapid debasement, and that's going to be reflected again in everything value wise going up, even if it's not proportional to what you would consider from earnings and that. And so it's something where you have to have a bit of a disconnect to those realities. This is not too different than what happened in the early 70s when you saw values for real estate and everything else. Everyone's like, well, with rising rates prices should go down, and that no, actually you saw home values in that triple in some cases in popular markets simply because of inflation. And that's not going to change, but it's also going to be reflected in rents until you reach a point where, like when I was in California, you could see it at the point people were paying more in property taxes than they used to pay for mortgage payments. And that was right around that 2008 range. And it just got to a point where it's not sustainable. That's the game that's played back and forth. And so that will continue to go until it doesn't work. And then we'll figure something new out. But in the interim, we just play with what is, and the readings are pretty clear for us. So just keep going with them. So as always, though, anything relevant, I'll put it up there in the Skype chat. But as always, trade well. Have a good one.